Now we will go to the quantitative measures of credit control. So I already said that central bank takes some steps. It takes two types of steps, that is quantitative credit control and qualitative credit control. So what happens in quantitative credit control? Here, the credit that is extended to all the sectors, whether industrial sector, agricultural sector, individuals, every sector faces the same consequences of any kind of step taken by central bank. But in case of qualitative credit control, here the central bank, suppose it decides to increase the credit flow to industrial sectors, they need an increase of funds. So the credit control will be biased towards some sectors and not biased for the other. So we will come to the qualitative aspect later. First, we will go to quantitative measures of credit control. So here, whatever step the central bank takes affect all the sectors equally in things related to credit. Now, what is bank rate? Now, bank rate, when we take loans from the commercial banks, since commercial bank is the bank which serves as a bank for the public, general public. So when we take loan from commercial bank, we don't get it for free. We have to pay an interest which is charged on the principal amount. For example, if I am taking 1 lakh loan and I have to pay an interest of 8%, that means 8% of 1 lakh is the extra amount which I have to pay during return of money. So we can also tell that the interest charged on us is actually the cost of availing such loans from the banks. So when you go to market to buy anything, you buy the product and pay its price. Similarly, at the time of emergency, we get the loan extended from commercial banks. But when we have to return, we have to give the excess of money than the amount which we have taken out from the banks. So that is the cost of taking the loan, cost of getting the money from the banks during the time of need. Now, when the cost is more, do you buy the product? No. When the cost is less, you try to buy the product. In the same way, when the cost of loan is less, that means interest is less, we have to pay back less amount of extra money in return after paying the principal. That is the time we avail loans. And when the cost is more, when the interest charged is more from us on taking loans, we try to avoid taking loans. In the same way, for the commercial banks, who serves as the bank? The commercial bank are the central bank. Now, from time to time, commercial banks also require money for giving general public loan, and it makes all these from the deposits that are stored in the commercial bank. But apart from the deposit, if they require more money, if they want to make more loans in the economy and earn more interest income, they often take loans from these central bank. So suppose central bank, it is a bank to the commercial bank. So commercial banks, they want to earn profit. They want to make profit from the economy. Now when they earn profit, when they can give more loan, they earn more interest income. Now from where do they give out loan? You all have seen the function of commercial bank. They are the loan creators. Whatever amount of money the savers deposit, the commercial banks uses that for loan. And sometimes the commercial banks borrow from the central bank. They borrow the amount of money from the central bank to give out loans to the general public. But central banks, if they are giving commercial banks loan, when at the time of return, the commercial banks have to pay the principal with the interest amount. So central bank suppose have given 1 crore loan to commercial bank. So when the commercial banks have to return, they have to give the principal as well as the interest return charged by the central bank. So how much interest is charged basically signifies the cost of loan. So bank rate is the rate of interest which the central bank charges on the commercial banks for giving out loan. So it is also known as cost of loan. So if the bank rate is high, that means central bank is ready to give commercial banks loan but at a higher interest rate. That means commercial banks at the time of return have to pay more. Cost of taking loan is more. So commercial banks like general public also avoid taking loan during this time because they have to pay more from their profits to the central bank. So when bank rate increases, the commercial banks cost of availing loan increases, and that is why they will not take much loans, and when they don't take much loans, they have less holdover money. Can they create more loans in the economy? No. So their credit creating capacity will reduce. So whatever loan they are giving, they are now giving less loans because their credit creating capacity is less. But they are profit maximizers. They will always want to increase the amount of profit earned from the economy. So what they will do? On the existing loan, they will charge a higher market rate of interest. That means those to whom the commercial banks is offering loan, from them they want to charge a higher interest so as to increase the profit. So market rate of interest which the public have to pay to the commercial banks for taking loans will increase. So for us, for the general public also, the cost of loan increases and people will avoid taking loans. So general public will now take less loans. So money supply in the economy will be less. People can take less loans now because cost of taking loans is much more. So you will not take loan and you will avoid purchase of many things. You will not create demand for certain things and try to demand it at a later date when there will be money. So demand falls in relation to supply. So this is a disequilibrium state where the economy lands up. So there is excess of supply in the economy. Now this excess supply means there is less of demand than the supply. So only if price gets reduced, the demand can be increased. So this is the final step, price decreases. So central bank, what it has done, it has taken one step, that is of increasing the bank rate. That means the rate which the commercials have to give if they take loan from central bank. So cost of taking loans by the commercial bank increases. So they will avoid taking loans and they will create, with that money they used to create credit, give public's loan. So the credit will fall, they will give less money to the public, but they will try to maximize the profit by charging a higher rate of interest. So now they can give loans to less number of people, and how they can maximize profit by charging more rate of interest from them. So general public will face again a problem because the cost of loan increases, money supply will reduce, supply will be more than the demand, and automatically it leads to price fall. So why the central bank has taken this initiative of increasing bank rate? Because it thought only by increasing the bank rate, the result price drop can be achieved. It also signifies that central bank wanted to solve the problem of inflation. So when central bank takes such a step to reduce the price, it means in the previous period there was very high price or there was problem of inflation in the economy. So bank rate increase taken up by central bank is a quantitative measure which tries to solve the problem of inflation that persisted in the economy. Similarly, what happens if this bank rate drops? Just the opposite. It drops means now the commercial banks can take easy loans from the central banks. It has to pay the principal back to the central bank and the interest amount is less. So the excess money that is given to the central bank will be less. So the cost of getting the loan is lesser. So commercial banks cost of availing loan decreases and they will now try to take more loans. So when you have to give less interest, you will try to take more loan. And what the commercial bank does with taking more loan, they give more loan to the public. So their credit creating capacity increases. So when they can give loan to many number of people and they are getting this interest income from many number of people, they will not charge a single person a huge rate of interest. So the market rate of interest will drop. Now the general public will see that now if I take loan, I have to pay less interest. That means the cost of loan reduces. So general public will now take more loans and automatically money supply will increase. Now this is the time when people will demand more than supply, and what will happen? The prices will increase as a result of increased demand, because when the suppliers cannot supply with the products to all the demanders, they increase the price, which results in fall in demand and it equalizes or becomes equal to the supply. So price level increases. That means RBI has taken the step bank rate reduction in order to increase the price in the economy. That means what was the problem previously? Previously was the problem of reduced price, which RBI thought has to be increased. That means previously the problem was that of deflation. So RBI wanting to increase price means there was very much fall in prices before. So the economy suffered from deflation, and to avoid this problem, overcome this problem, bank rate reduction was necessary.